Welcome to the Gold Newsletter Podcast, your bank of knowledge of investment, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives.
Fergus Hodgson, your host. Always pleased to be with you. Thanks for tuning in. And I'm delighted to have Robert Shoss with us today. He is a private investor and a lecturer at the University of Houston. And I recently came across him through one of my own courses. And I just thought it'd be interesting to have him on to discuss two themes. But first, Robert, welcome to the show. It's our privilege to have you.
It's very kind to have me, and I appreciate the opportunity. Thank you.
Right. Now, you touched on two issues that I found most interesting, but the first one was your concern that you noticed a rise of students basically having less confidence in capitalism as the foundation for the United States. And you are concerned that the United States is losing that. Do you want to be more precise about what you observed and what the implications are?
Sure. To me, I'm not new in this. This is not an epiphany for me. It's what I think what trends have been showing, surveys have been showing over time. And my concern is that over the last, since the United States has come into being and the great economic powerhouse that we've created, so much of it is driven by our economic vibrancy, which is our capitalistic system, our free enterprise system. And without question, a lot of the issues that are economic, we have a lot of challenges as our country. And a lot of it is because there's some deep challenges in the structure of how free market capitalism is playing out. And so I fully recognize that, and they need to be rectified. Some of the best minds out there are working diligently on those efforts, such individuals such as Paul Tudor Jones and Ray Dalio. And so this is not a new realization or a new find. It's reading surveys, it's reading studies, and seeing the challenges that are transpiring in our country and our economy. However, I think it's so important for us to recognize that free markets and capitalism is historically, and I think will continue to be by far the best means by which we as a country can grow and prosper. We can bring individuals out of poverty. There's just been no better way in which we can do that, and you can compare it to any other economic structure. It's superior. Again, I want to be clear. I'm not suggesting that there aren't some serious faults that need to be rectified, and there are, but I still don't think we throw everything out. And the last thing I would say about it is, one of the best investors probably ever is Warren Buffett. And having studied Warren Buffett over the years, it seems as what he always discusses as the United States magic is just that. It's our free market capitalistic system. And it allows us to grow over time. It allows us to grow earnings and to grow cash flow and to grow, on a family basis, to be more productive and more successful. So I'm just worried that the argument is not continuing to be one that capitalism is the superior form of a country being able to grow and prosper.
I tend to agree with you. And one of the manifestations of this is that even chief executives are apologizing for their activity, just being businessmen. And two examples. One is this push from the private basis, actually, for what's called stakeholder capitalism. And other are these diversity mandates that many firms will now adopt, which are, I guess, trying to placate or avoid higher regulation in this regard. But are there particular developments you see on the margin that are undermining capitalism in the financial sector?
I'm not sure I can get too much in the weeds on these issues, and I haven't spent a lot of time figuring out solutions. I know that there's a lot of efforts being made to deal with it. I really don't know. I'm reading, trying to learn, trying to understand. I don't have any strong opinions on it. So I apologize. I don't have a really good answer to that question. I do feel really good that some of the best and the brightest in the world and a lot of resources are being dedicated to this. So I'm, in one of the ways in which I feel, again, that I think plays to the strengths of free markets and capitalism is over time, the best ideas went out. And so my hope is that these resources, these great minds will create opportunities, will make changes in the marketplace in which we'll get some traction to help us deal with some of these issues. So I apologize, I don't have a good answer to you. I'm not that well versed in it, but I do feel over time, with the attention and focus that's being given to it, I'm optimistic we will continue to make inroads to deal with some of these challenges, and also, my hope and prayer is that we continue to recognize the importance of having a capitalistic system.
And is there a particular publication, article, or book you might point people to raise their awareness?
I'd have to think about that. I've done one of the kind of books I enjoy reading, or I love reading inside views from successful entrepreneurs. It could be Bob Iger, it could be Steve Schwarzman. I mean, there's a ton of them, and so there's a lot of books over time that I've read about from the ground up. The Howard Schultz's, and it's no question how they were able to be successful is because of our free market capitalistic system. I haven't read like a top-down ideas generated book that stands out, except for these themes are so pervasive, and anybody who's able to start a business and be successful, Phil Knight with Nike, the travails he had, it's free market at its greatest. To see how despite all the heavy challenges, and in many cases forks at the road where things could have ended very differently, that entrepreneurial spirit, that resiliency, combined in a structure, a governmental structure that allows you to be successful, you can overcome all those things and be successful. So no, not from the top down, but there's so many great from the bottom up stories from individual entrepreneurs who have been successful. That's the direction I would point to.
Yeah, I'm going to inject a few of my own here. So
Please
Conscious Capitalism by John Mackey, the founder of Whole Foods Market, is a wonderful starter there. And for people who are just coming to the ideas of free market economics, the classic is Economics in One Lesson. And I can't believe it, I've forgotten the author right now. But that one, we'll put links to both those in the show notes. So go to goldnewsletter.com/podcast to get those. Now, you mentioned also to me before that you teach 3 courses, or maybe you're working on a third for the University of Houston. And you are concerned that even successful people who may be successful in their careers or academic lives fall down when it comes to finances. And that's why you are particularly motivated to teach personal finance. Do you want to clarify what you mean by that? What are the common patterns of people just failing and that having a permanent or a lasting effect on their opportunities?
So that's I appreciate the opportunity to address this, and this is kind of a personal mantra that I've taken with me, and it's one of those things. All the classes I teach, I try to rewind the clocks, because I was in your shoes once upon a time, and what would be the classes? What would if I could reverse rewind back to when I was in school? What courses would I like to learn? What information would be powerful for me? What would be impactful for me going forward? In personal financial planning, has proven to me to be one of the most meaningful ways in which a person can really raise their standard of living. Small changes get compounded over time and make big differences. And so what happened is, over time, I found, and this is many of the cases looking in the mirror, because I was the one who was making very, very bad mistakes, and learning from my own mistakes, trying to figure out ways in which I can help others to prevent them from making the same mistakes. So a handful of things that stand out. Something as simple as just having insurance. One of the biggest ways someone can really fall on the wayside and really struggle and may not be able to pick themselves back up is if they don't have the right insurance. It can be personal insurance, liability insurance, health insurance, but if you're not properly insured and you have bad fortune and something happens, it can really be a catastrophic blow for you. So insurance stands out as one area that so often gets neglected. It's not fun, but it's important nevertheless. Even something as simple as saving, and saving consistently, continually, and then investing well. And when I say investing well, I'm not saying you have to be the next Warren Buffett, but even just owning diversified index products, but diligently putting money aside, especially when you're young, in a thoughtful way, keeping costs down, diversifying not just across the United States, but globally, in different market capitalizations, different size companies, and then also in different asset classes. It can be instrumental and grow over time and really make big differences in one's life. So those are a couple areas that stand out that I know I would have loved to have heard and applied some of those concepts. And the last thing I'll say about it is this doesn't fall in any particular demographic category, socio-demographic category. It is across the board, because over time, I've been fortunate enough to make a lot of friends and colleagues, and my network include a lot of very successful professionals who are just clueless. They just have no idea how they should be investing. They have no idea how they should be, proper insurance. So it's all of us who fall prey to it, and it's hopefully if there's a person out there that it can make a difference for, I think it's an important cause.
Yeah, and because this is the Gold Newsletter podcast, and we often talk about mining stocks, precious metals ownership, anything out of the ordinary, really, things that we see as interesting. Now, of course, these offer all sorts of different, reasons for getting involved. And I know we've had the president of the 𝗂𝗽𝗱 Association, the Chartered Alternative Investment Analysts Association, and he has encouraged people to think of alternative investments as diversifiers rather than places to get higher returns. Now, what wisdom do you teach? You said you mentioned diversification both across sectors and across countries. How much diversification should there be in alternative investments?
That's a great question. I wish I had a silver bullet to answer that well. And there are, just like, I think there's going to be different answers for different individuals and different institutions. I was reading yesterday an article discussing endowments and how Yale, I think, has, how they were one of the prescient, with David Swensen, how managers and been very successful, and how they kind of have led the move away from public equities. And I'm not suggesting that's the right way to go. I'm just suggesting it's been a successful model for Yale over the last at least couple decades. And they've got very, very big footprint in alternative investments. So I think so much what's going to come down to risk tolerance, how soon you're going to need those assets. There's a lot of alternative assets do have some very favorable characteristics, but they also carry with it other not so favorable characteristics that could be challenged if you need that money soon, if your risk tolerance isn't, if you're okay, having that money put away illiquid, and also potentially in classes that are underperforming for a period of time, because it's going to act very differently than public equities or fixed income in many cases. So it's a very, very personal question, dependent upon underlying institution or individual, the risk profile, the need for there's a series of questions that would have to be asked. So it's a broad bucket. I can speak for myself and say I have a pretty high bar for what I would be interested in terms of alternative assets. And I guess one of the questions would be, and I'll ask this back to you, what is considered to be alternative assets? Is real estate alternative asset?
Yes, it is. Yes, okay. Real estate is. Yeah.
So if you're going to say real estate, I would say commodities is probably is considered to be an alternative asset. I would think gold and
of course, yeah,
yeah. So it's too hard of an answer. I can't get too granular with it because I think it's too much dependent upon the needs of the underlying either individual or consumer. But for me, I am concerned over the long term on inflation. And I'm also, I think that there are opportunities in alternative assets in general, like real estate, that can create opportunities. So I certainly would not be against having alternative assets, but I would also, just make sure it's a match to your risk tolerance, your temperament, and your need for that liquidity.
The Gold Newsletter podcast is proudly sponsored by the Discovery Group of Exploration and Development Companies. To learn more about our exceptional track record and exciting future, visit discoverygroup.ca.
Hello listeners, I am Daniel Duarte and I am here with this week's CEO for our segment with the Discovery Group. As you all know, each episode we get to know more about a company within the group, which is a sponsor of the Gold Newsletter podcast. Today I'm so pleased to have Frederick Bell with me. He is the CEO and Director of Elemental Royalties, The company has a portfolio of primarily gold, but also silver, some PGM projects around the globe in Africa, South and Northern America, and in Oceania, namely Australia. Elemental Royalties is listed on the TSX Venture Exchange with the ticker symbol ELE. Frederick, welcome back to the show.
Hi, Daniel. Great to be here.
So it's been roughly, 2 months since you started trading on the Toronto Venture Exchange. What has been the market reception so far? What kind of feedback and interest have you garnered from the industry?
Well, it's been a very fast-paced 2 months for us. We thought it might be a quiet summer, but very much the opposite. And I think in the first 2 months we've had an awful lot of meetings, as everyone does now, virtually, with investors, institutional and retail investors, attending conferences and meeting brokers and investment bankers and corporates across the world, really. I'm calling in now from London in the UK. So we sort of wake up in the morning and talk to Australia sometimes, and then Europe in the middle of the day, and then the East Coast of the US and Canada, and the West Coast as we come into the night. So it becomes a full-time, it really is a full-time commitment, but it's been really enjoyable, and the response has been excellent. I think we did the fundraise, very heavily oversubscribed fundraise at $1.30, and we've traded generally, I think, between 160 and sort of 170 since then. And I think at the moment we're probably at about 155. So we've traded up significantly since we listed. And I think the most pleasing thing has been the amount of liquidity. And so for a roughly speaking 70 million Canadian dollar company, we've had about $11 million traded in the first 2 months. So I think that's really positive for a new company, because it means that investors are hearing about us and we're starting to get the story out. And I think that's one of the key areas that we're really focusing on now, which is introducing the company to new people. Excellent.
In your last call with Brian, you mentioned that you are new to the market, but not new to the royalty base. So why don't we zero in on some of your projects? What kind of royalty streams are you bringing to the broader market?
The key differentiator for us is that as a very small royalty company, we have some very good quality producing royalties. And the biggest royalty and most material is on Teranga Gold's newly built wane gold mine in West Africa, in Burkina Faso. And that is a roughly 150,000 ounce a year gold producer. And it has a 10-year plus mine life to start with. And they've said that they're doing exploration now to push that out to 15 years. And we have a 1% gross smelter royalty on the mine and all the exploration around it for the rest of its life. And that's our biggest royalty and most material. And for it to have come on stream at the end of last year, it's very pleasing to see it do so well. And one of the great things with the royalty model, as I'm sure some of your listeners will know, is that you get all the benefit of future exploration, investment, production at no cost to the royalty company. And so having really long life, good quality assets like that, they really are a premium commodity in the royalty space. And some of the other royalties we have a royalty on Austral Gold's producing 𝗵𝗁𝗃 mine in Chile, on Base Resources' 𝗂𝗚𝗱 mine in Kenya, and on part of Zijin's Paddington Mount Pleasant mine in Western Australia. And the last one over an operating mine is on Premier Gold's Mercedes mine in Mexico that starts paying us from July 2022. And I think that, again, biggest differentiator is you typically see a junior but new royalty company with 10 exploration royalties and maybe 1 producing royalty. And we have 6 royalties, 5 of which cover operating mines. So from the outset, we have cash flow positive, we have diversified revenue, and I think that gives us a really, really strong foundation to build the company from.
Exactly. So in late August, you put out your second quarter results, and you argued that you posted record royalty revenue. What has fueled that trend, and what other catalysts do you foresee for the rest of 2020?
So yes, it was our best quarter in terms of revenue. And since we started this company privately in 2017, we have nearly doubled the revenue every year since we have every year since we started. So very fast growing in terms of actual real revenue that we receive. And we're on track for a bit over 5 million US in gross revenue for 2020. And I think the main drivers are the new acquisitions we've made. And also, obviously, we are directly correlated with the gold price. So if the gold price goes up by 10%, roughly speaking, our royalty revenue goes up by a similar proportion. And so we are a very good way for investors who want some precious metals exposure to play the royalty space through a diversified vehicle with low overheads and high revenue. And that really is the benefit of the royalty model. And I think as we grow and continue to grow, we're going to be a more and more attractive investment opportunity.
Well, Frederick, thank you for your time today and updating us on elemental royalties and its opportunities. We will definitely keep a close eye on it.
Fantastic. Thank you for having us, Daniel.
Yeah, the Yale endowment is an interesting case because, as you say, they have led the pack of endowments and achieved over 13% compound annual growth rate for something like 20 or 30 years. It's really an incredible story. And they have an interesting model whereby they have these, smaller funds dedicated to particular non-traditional investments, and they build these partnerships. And I just take it seriously because it is true that there are fewer and fewer firms listing publicly. And as markets get more efficient over time, getting these high gains to me seems more difficult. Is that the case?
I don't think there's any question. I think I'm a huge proponent. I'm very hypocritical because I manage on my own, but I also my expenses are my time, and I love it. So to me, it's a passion, and I intellectually get challenged. I learn, so it's a great journey for me. The problem you end up having so often, and one of the biggest problems, biggest disadvantages with alternative assets is what you address, which is costs. It can be prohibitively expensive to have. Alpha is very hard to generate, and once you take into higher costs, it becomes more and more difficult. You're correct. The market has gotten much more difficult to beat over time. It's a zero-sum game, and the players are a lot smarter. You're sitting at a poker table with a lot better poker players than was the case 20, 30 years ago. But it's also a case where costs have come down so dramatically for all these indices. It's free for better or for worse. To have exposure to the broad market, and it's hard to beat a free when there's no expense coming out. The bar gets higher for active managers to outperform. So yes, I agree with you. Alternative managers do have broader asset classes to find opportunities to outperform, and there's no question there's more inefficiencies in certain asset classes than others. But in many cases, they also have a anchor of higher fees, higher costs that are embedded in it, which makes it more challenging. So, and again, I'm going to be very clear. There's no question in my mind, some active managers have crushed it over time, and they have a process, a team, a philosophy that I think will continue to have great success. But generally speaking, most active managers have failed to justify having assets and being able to manage.
Yeah, and one thing about the Yale case too is that they have something like $20 billion. So of course, there are huge economies of scale when you can spread those research costs over a fund like that, whereas the individual investor will struggle to compete. So, do you want to comment on that?
No, I think that's exactly right. I think their ability to get it's the 𝗀𝗶𝘀𝗰, someone who wants to, or what I'm mangling the individual on it, but someone who was willing to let me into their club is probably not a club I want to be a part of. So you're right. So Swenson's going to have opportunities, and some of these individuals are going to have opportunities to get into assets and with managers that we would all love to, but they're not going to be interested in us. So that's another element. You're right. Size creates big impediments without question, because it's much harder to make a difference when Warren Buffett's managing so many billions of dollars. It's much more difficult to drive alpha than it is a smaller pot of money. But you also, it creates opportunities to invest with certain individual managers that you otherwise, people like you and me, would not have the capability of being able to. So you're fully agree with that.
Yeah. Okay. So that you are not a big social media man, and you said you've got one Pinterest account which is not super organized. So if people want to learn from you, they basically have to go and take a class at the University of Houston. Now we will put any links you want to share with us on the show notes. But for now, basically, if you want to follow this guy, he does have a Pinterest account, and I guess people could reach out to you by email, or if you have such a passion for finance that you're open to dialogue or engagement.
Please do. And then also, I'm considering expanding my social media imprint. I mentioned to you before, I guess you gave me the term for it. It's a looker. So I kind of express myself trying to do well. I have a high bar to figure out what the value I can bring versus so many erudite, outstanding resources out there. So I'm only trying to make a difference in an area that I think I can add value. It's different than somebody else. So that's why I've kind of been in some ways selfish, but also a looker with gathering and learning from all these social media, but not also providing so much, because in many cases the bar is really high because there's such great, outstanding resources, investment resources, financial, personal financial planning resources, that I don't want to just be anybody else. I want to do, if I'm going to really spend time and focus on those outlets, I want to make sure I've got something really different and value add to bring.
Right. You don't want to just shoot your mouth off, I guess, like so many people do on these platforms. Yeah. The term is lurker, which I learned a few years ago. I had to be taught that one too. So people who observe but don't engage are lurkers. Okay.
Lurkers. Okay.
Yes.
Got it. I thought it was a looker. I got it. So
yeah.
That tells you how out of touch I am.
No, mate. I'm going the opposite way, and I'm scaling down my social media because I just fear it takes a lot of time, and it's not necessarily healthy psychologically to always be engaged like this, and a lot of animosity it can be. So it's a tough environment because so many anonymous accounts these days, and people makes people feel emboldened to attack you. Yeah. But I don't want to get stuck on that. Robert Shoss he is a private investor and a lecturer at the University of Houston. And I'm so glad to have had him on the show. Thank you.
Thank you so much. Really appreciate the opportunity. Keep up your great work.